Welcome to Wall Street Unspun with your host, Peter Schiff.
But it's a giant bubble in search of a pin, and it's going to find one.
Are you confused with the ups and downs of the economy and what it means to you?
Don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, you're not getting investment advice. You're getting propaganda.
Get ready to untangle the web of misinformation provided by the mainstream media.
These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock.
And now, here's your host of Wall Street Unspun, the president of Euro Pacific Capital and a licensed broker with a passion for truth. It's Wall Street Unspun with Peter Schiff.
Hello, everybody. Welcome to Wall Street Unspun, December 30th broadcast. Happy New Year to you. Heyman Kathuria, branch manager of Euro Pacific Capital, Los Angeles, sitting in for Peter Schiff, who hopefully will be able to join us on the second half of the show. Well, we've got big news out there today. Fannie and Freddie, GMAC, where do I begin? Let's start with Fannie. I mean, we got a situation where the current amount of the bailouts from the Treasury are sitting at $112 billion. Well, they're going to take the cap off. It's unlimited now. We're going to be able to pump as much money as possible both Fannie and Freddie ad infinitum. I mean, give me a break, guys. When does it end? We're talking about a Treasury estimate that over the next 10 years, the money that they have to put in will not exceed $170 billion. Well, you know, we're already at $112 billion. Now, the U.S. mortgage market is $11 trillion, of which half is currently $5.5 trillion, to be exact, is guaranteed by Fannie and Freddie. The Treasury trying to tell us that even though we're already at $112 billion, over the next 10 years it will not exceed $170. That's impossible. According to our estimates, we think that we're looking at massive defaults. So the amount of defaults will probably exceed $170 billion in 2010. That's the Euro Pacific Capital estimate. So I think based on what we've been saying is going to happen over the last decade, and based on what the government is telling you, I'm sure you can draw your own conclusion whose numbers are better. Next, GMAC, $3.8 billion on top of the already $12.85 billion that the government is pumping in. Well, what does that mean? Well, in round numbers, we're at 56% government ownership, well on our way to an eventual 100%. You know that's coming. The path of socialization continues. We've got, you know, the continuation of the pattern, and everything Peter talked about in his book prior to it happening is just continuing and expanding. You're talking about the privatization of profits and the socialization of losses. That is a shame, and we're going to have to continue to keep on fighting the good fight. What else can we do? And this rally in the Dow Jones has traced out a classic retracement. We've seen the S&P 500 get to the 50% retracement level from this big drawdown. And what does that mean? Well, we've gone nowhere. When we're still continuing to go nowhere fast, the guys in Wall Street basically have looked at these figures, and they say the worst is behind us. If you want to listen to what Peter's saying and what he has been saying, he was on Glenn Beck yesterday. I believe that's up on YouTube. You can go ahead and catch the analysis, as always, right spot on. He crystallizes what he thinks is going to happen into terms that are easy to understand. Now, I talk about the S&P and say that we're going nowhere fast. What does that mean into terms that look at the big picture? Well, this is very, very accurate to call this last decade the lost decade. We've gone nowhere. We're down. The broad stock market in the U.S. is somewhere between 15 and 20% in the negative territory. You compare that to the overseas markets, or markets that Euro Pacific Capital is investing in, and you can just see that over time how much of a difference, how much of a tremendous difference there is between investing abroad, getting out of the dollar, protecting yourself from all the deficiencies in our system, and what that would get you. Brazil, Russia, India, China. That's the BRIC countries. New York Times did an article on this today. Well, what did the article say? Well, BRIC countries in aggregate are going to surpass the U.S. in imports. Now, you hear about the U.S. consumption-based economy and how the consumer drives things. Well, we've been surpassed. The BRIC countries have passed us up. It goes right in line with the growth in their GDPs, with the flatlining to decline of our GDP. In fact, the global GDP numbers, you've got the BRIC countries, and if you include the Middle East with that, they're actually 36% of global GDP, and that's climbing. I mean, that's up from 21% 10 years ago. So as the U.S. becomes less and less relevant, the other parts of the world are more and more relevant. The GDP in the BRIC countries is still, it's growing fast. 6.3% is what we think is going to happen next year. And what happened in the stock market? Well, I quoted the figure for the broad U.S. market, down about 20%. Now, what happened in the foreign markets? Russia, up 800% over the last decade. Brazil, up 300% over the last decade. India, up 250%. China, up 150%. Now, think about this. The S&P 500 yields less than 2%. Dividends are being cut. The only ones who are really making any money are the CEOs and CFOs and top management of these companies. I mean, you've probably heard the statistics. The CEO of an average S&P 500 company makes 250 times what the workers make. This is something that is going to really continue to drive stock performance. There's no money left for dividends. There's no money being invested in the businesses. It's all going into the management. So that's not the case overseas. We are overseas where America was in the 1950s, when we were the manufacturing powerhouse of the world, when we were producing, when we were able to support a growing family with only one person working. I mean, right now you've got both spouses working, and they're still losing steam. So the situation is that the growth is continuing unabated overseas. You see oil at $80. You see gold above $1,000. And the movement that we've seen here has climbed the wall of worry. There's been a lot of people who doubt it. Now, here the holiday season, I'm working up from my office that I maintain in my home in Northern California, and I had a meeting today. I had 3 clients come in, and they're asking what's next. They wanted me to talk about the inflation versus deflation debate, and we discussed that. We had a robust discussion. They're saying they had been hurt in the past with other advisors, and they now are ready to put money to work, but they're afraid that we're going to go into a double dip scenario. Now, Peter's been on record stating that this is a fake rally in the U.S. market, but it's driven by inflation. Now, the Federal Reserve can print as much money as they want. So we are going to see these type of mixed signals. I mean, an example of that would be something that I've done here. I've taken my top producers up to Lake Tahoe. We just, had a trip. I thought you guys we had a record year for our clients and for the brokers that performed really well in my office. I thought the nice thing to do is take them up for a little ski trip, 3-4 days up in Lake Tahoe. Now, why am I mentioning this? Well, price of everything has dropped. So you've got certain segments of the market actually in deflation. I was actually able to go rent a private jet and take these guys up there. We hit the ski slopes. The ski slopes were empty. I mean, we're talking about Christmas and New Year's, the busiest week. The high end is suffering tremendously. We expect that to continue. The commercial real estate market is just on the cusp of the next leg down. But on the other hand, you've got the central banks. They are going to try to force people to spend money. The savings rate going up, the people trying to up their own personal cash hoards, and you can see that in evidence, just like we saw it last weekend, where there's people tightening up the purse strings and not spending. Well, the Fed's not going to let you do that. They're going to keep rates at close to zero. They're going to make you spend. So that is the situation. As inflation increases, as that monetary base keeps getting pumped up from the Federal Reserve, you're going to see prices head north, and the nominal level of the stock markets might go higher. Doesn't matter. Don't get fooled by more money forcing nominal prices higher. And the situation in the 70s where you had transistor radios and television sets and all kind of gadgets dropping in price is similar to what we have right now. There are things that are dropping in price, but there's going to be the more important things that are continuing to rise in price, the food, the energy, the types of things that you need. Now, with oil at $80 and pretty much everything that we need cycling in from petroleum, you can only imagine the inflation that's in the pipeline. So that is going to continue. We expect it actually to increase, and that's the scary thing about it. It's the prospects for what's going to happen going forward. So I explained that to these clients. They very much understood it, and we are going to be defensive, but at the same time, get out of the dollar. The dollar is the real risk. We've seen a move up. The dollar has broken above the 50-day moving average. I expect it probably to head a little bit higher, maybe to the 200-day moving average. We need to bleed out a little bit of that one-sided thinking. I mean, the percentage of people that were bearish on the dollar got to 97%. Now, obviously, if everybody's bearish, then there's nobody left. So right now, we got to drive it up a little bit. Week, 2 weeks, 1 month. What does it matter? It doesn't matter that now you have the ultimate opportunity. You have the opportunity to get out of the dollar. Take this opportunity, make your move, start allocating assets out of the dollar. Those figures I just gave you over the last 10 years, if those don't bring it all home for you, I don't know what will. You need to go out and call a broker at Euro Pacific Capital. We're on the West Coast right now, so there are brokers. Even during this holiday period, in all the offices, Newport Beach, Los Angeles, Scottsdale, 800-727-7922. Direct number in Los Angeles is 310-826-2975. I am going to be taking questions in a moment here, so if you want to ask a question, 888-678-9597. I am going to be taking calls. Just give me a couple more announcements to make, and then I'll start doing that. Now, itinerary. Peter's been in a town hall meeting today. He's been doing many, many town hall meetings. He is continuing on the Schiff for Senate campaign that is building momentum. It's really exciting. I think that the polls that show him beating Chris Dodd are something that you should look at. I mean, the population as a whole really is starting to get it. I mean, personally, I spoke at the End the Fed rally last month, and we have over 100 co-sponsors for Ron Paul's initiative, H.R. 1207, to audit the Fed. So more and more people, not only on the mainstream, on the public, but on the politicians are really getting on board. Next up, this is really interesting. There's a university in Guatemala that actually focuses on Austrian economics. Now, why would I mention something in Guatemala? I'm just using it as an example of the fact that overseas they get it. They understand inflation. They understand that Austrian economics is the only real economics. So what they've done is they've invited me to come down there and speak not only for the students but also for the teachers. And this was a direct invitation from a corporate client of mine. It's a large sugar company down there. It's funny because these guys called all my competitors. They called Goldman Sachs down there, Morgan Stanley, Smith Barney. They wanted to set up a corporate account, and none of the guys gave them the answers that they wanted. These people are already in dollars. They wanted alternatives, and the Wall Street guys could not give them any alternatives, so that opened the window. They called us. They're fans of Peter Schiff. Peter Schiff is known around the world at this point, and so I'm going to go fly down there and meet with some of the people in that corporation, and at that same time I'll get to speak at the Universidad Francisco Marroquín. So that's coming up in January. All right, well, enough of that. I want to go ahead and take some calls. Some of you have been waiting very patiently. I see Ellen in New York has been holding for quite some time. Ellen, are you there?
Yes, I'm here.
How are you today?
I'm good, thank you. A little cold in New York, but other than that, I'm okay.
Okay, good. What can I do for you today?
I have a couple brief questions. I'm wondering if you could just remind us, why is it that Japan did not have inflation when they were doing all the things that we're now doing. I know Peter keeps talking about inflation, and believe me, I'm seeing it as an individual.
Sure.
I'm trying to figure out what's the difference between us and Japan when they started all these things that they did, that they wound up with a deflation problem instead of an inflation problem.
Well, let's break that. I'm going to break the answer up into several parts. Let me take you all the way back to the early 70s. Now, you had the Japanese yen at 365 yen to the dollar, and in the post-World War II era, they had to reconstruct their entire economy, and they had a long, painful process. And as they built up that manufacturing base, their currency was relatively weak. Now, as they became the manufacturing powerhouse that we know them to be today, that yen appreciated. Now, 365 yen to the dollar from 1971 to 1994, a 23-year period, it went to 75 yen to the dollar, so almost a four-fold increase in the Japanese yen. Now, that is very, it makes imports very cheap for Japanese as their currency gets stronger and stronger and stronger. So that's going to keep inflation down. It's going to keep the process of somebody going to buy an imported product. It's going to keep that cost going continually downward. So that the strong currency actually is helping to control the inflation in that case. Now you have 1994 to 2007. Yen got a little bit weaker. I mean, it went from 75 yen to about 120 yen, which seems like a lot, but not really in the context of that huge drop. And now, once again, we're back near 75, 85 yen. And why wasn't there a lot more inflation in the economy? Well, we got to talk about the definition of inflation first. Now, inflation is defined by the increase in supply in money and credit versus the effects of inflation, which are prices. So you want to see prices going up and then say, oh, there's inflation. That's not exactly the definition of inflation. So we had to separate the two things. Now, prices were in a general deflationary period in Japan, but they're not the same as the U.S. Let me explain the differences. You've got the Japanese who are maintaining trade and budget surpluses. Yes, the Japanese government has a lot of debt, but in aggregate, their balance sheet in aggregate is okay. You have most of the outstanding debt of the Japanese government is owned by the Japanese citizens. So they are invested in their own debt. They're a nation of great savers. And part of the reason that prices just flatlined for all this last over a decade and a half, is because of that. The propensity to save and to tighten the purse strings when times are tough has kept prices low. The second thing is the demographics. You've got the Japanese population, which is tending it's about 15 or 20 years ahead of us in terms of the age of their population. Let's face it, as you get older, you spend less. I mean, a lot of people tend to live pretty well when they're working full-time and they're making high incomes. When they retire, they tend to retrench. They know they have a certain amount of money, and that needs to hold them for the rest of their lives. So all those factors combined are going to keep prices relatively stable in Japan, whereas we have a different situation here. We did not have that propensity to save, not only on an individual level, but on a government level. So we're very different. There's a lot of leverage in our economy. We don't have the manufacturing base to support us, and the whole moving around of money from the left pocket to the right pocket and calling it GDP growth, all these financial, insurance, and leverage companies, that's not going to see us through this. So we've got a much, much different situation than Japan, and I think the future is very much going to fall along the lines as Peter Schiff has been spelling out pretty much, for the last decade or so. He's been right on, and I continue to see that. So we think the yen will be okay. The yen is definitely safer than being in the U.S. dollar.
True. But they're going broke, too, from what I've been reading. It's just, it's taken them longer because their population is aging now, and now they're going to need more of their savings that they had put aside.
Yeah.
But are you saying during that period of their quote-unquote lost decade, which at this point seems more like 2 lost decades, was their money rising in value during that time?
1994 2004 to 2007, the yen was slightly lower.
Slightly lower, but not much lower.
Not in the context of the big move up it had now, a normal correction.
Okay.
We're right close to the highs on the exchange rate between the yen and the dollar. So the yen has been a great haven for for people. Anyway, Ellen, it's been great talking to you. I've got 5 callers behind you. I got to move on. It was thanks for calling into the show. I'm going to take Eric in New York. Eric, are you there?
Hello?
Yes, hi, Eric. It's Hemant. How are you?
All right. Yourself?
Very good, thank you. What can I do for you today?
My question is on housing, and I was listening to Peter's video blog yesterday, and he basically says that even though housing prices have seen a blip upwards the last month or two, he says that that's due to all the government stimulus and in many forms, like 4 or 5 different forms, and I agree with him.
Well, sure.
My question is, he basically said at the end of that blog is that housing prices have to fall, but he was also saying that they could rise if the dollar falls hard enough and fast enough. That he almost makes it sound like housing might become a hedge on the dollar.
He's painting various scenarios because nobody can forecast in certainty which way, shape, or form this will take. We know that Ben Bernanke has promised to rain money out of helicopters. We see the news with Fannie and Freddie. We see the bailout with GMAC, partially because their mortgage division is in so much trouble. Now, we got 1.7 million homes which are in various stages of foreclosure that have been withheld from the market. So the conclusion is obviously when these homes hit the market, prices will fall and will fall dramatically. They have temporarily risen because of the moratorium on foreclosures, but that doesn't mean anything. The supply is out there. It's not going away. Yes, I mean, maybe some harebrained political scheme to bulldoze the homes or something crazy like that might come up. We can't predict that part of it. We can pretty much say for a certainty the politicians are going to keep throwing new and crazy ideas at the issue instead of getting down to the real cause. And the cause is the Fed. I mean, we had 0% interest rates. We had the Bush ownership society, which took the traditional ownership percentage from 65% all the way through 70%. I mean, all those people moved out of the renter pool in ownership, and I even hesitate to call it home ownership when you have 105% mortgages. So we've got to basically make you aware of the various things that could happen. The end conclusion that you must draw for yourself is in your local market, see whether it's cheaper to rent or to own. Most probably it's cheaper to rent, but there are some markets on the low end that have gotten hammered enough where you might be okay to go out and buy something. I mean, certainly you are a taxpayer, and so in one way, shape, or form, you are subsidizing all these harebrained schemes that the politicians put out there to try to prop up the market. So the market in aggregate is heavily, heavily overvalued, but there might be pockets where, as an individual, you can take advantage of recent prices, which may have dropped 70-80%.
Right, but if somebody's betting on like myself, for instance, betting on the fact that housing prices, for all the reasons Peter gave yesterday, and the 2 or 3 more you gave today, for lots of foreclosures, pending, et cetera, that if we're betting that housing prices are going to fall, especially when interest rates rise, my question becomes the conflict of the two, in the sense that on one hand we have all these reasons for housing to...
housing prices always fall. It's the land that appreciates. The actual upkeep, the cost, the various costs that you associate. Once you add all those up for owning a home, right now the answer is unequivocally that on a nationwide scale, on the average, you should be renting. Now, in your own market, there might be a special situation, so I can't really answer to that, but I can say that you have a depreciating asset, which is the actual property, and that will continue. So, I mean, that the long-term things that you look at where the housing prices just track the CPI, we got divorced from that in 1995-96, and we got 3 standard deviations away from that. So we're correcting that. We're not done. We will be there at some point in the future. It may be a year, maybe 5 years, but The question is, don't worry about trying to catch the bottom or the top. You're not betting anything. You rent your shelter. Now, whether you take a big loan from the bank or you actually pay a rent check, it's pretty much the same thing. So try to just, keep the emotions out of it. You're going to have plenty of time to be able to invest in housing at some point once the market clears. I mean, right now we're a little bit away from that. But Eric, thanks for the call. I've got callers on hold. I need to take David in California. David, are you there? Do I still have Eric, or am I moved on to David yet? Okay, David, are you there? This is Heyman speaking. How are you today?
Hi, Heyman. How are you?
Very good, thanks.
Hey, my question is about this recent dollar rally I've been eyeing carefully because I don't think it's going to last, obviously. But I would like to reinvest my dollars into some foreign currencies because I really feel like they're kind of at a bottom now.
Yeah.
That would be a good time to take advantage of that. And the one I'm eyeing most carefully is the yuan because it's pegged right now. And I really believe, as Peter has mentioned, that the yuan peg can't last, and as soon as the Chinese depeg their currency, it's really going to go up. And I would like to know from you what current currencies might be available right now and when you think the yuan will ultimately be pegged.
I'll give you a multi-part answer again. First of all, you've asked about the yuan. It is currently pegged. That appreciation that you saw, 5 to 6% a year, broke free. Actually, I should say the appreciation that they were allowing was halted in 2008 as the financial crisis hit worldwide. And what happened is they said, we're going to hold a line here. Now, the yuan has depreciated versus pretty much everything because of that, because the dollar's been going down. The Chinese currency had to go down with it. That cannot hold. The reason it cannot hold is by pegging themselves to a weak currency. They're importing inflation into China. You've seen M3 rate increases, the rise of M3, which is their money supply, going up and up and up. And so that's tremendous inflation coming through the pipeline. Now, why do you think the Chinese are literally going on TV and telling their clients to go buy gold and silver? So the situation is such that they know the end game is a depegging. And so at that point, you need to be out of paper into real currency. So they're trying to get people protected from not only the U.S. inflation but their own internal inflation. Now, one way to play it from your point, your base position right now is U.S. dollars. So are you better off being in one inflating currency or another? Obviously, you are better off in China because the end game is that the currency will have to break free. So you want to get out. If you have a lot of dollars, one way to play it is you can either think of the Chinese currency ETF. You could certainly buy some of the utilities that are trading over there. I mean, we have a lot of good ideas that trade on the Hong Kong exchange that will give you exposure to China. I think the Hong Kong currency will also be revalued higher. So you got to establish a beachhead. That's the first step. I mean, I think some of the bigger utilities in Hong Kong haven't even moved on this latest rally just because this has been more of a rally on leveraged kind of stocks. So if you have not yet opened an account with Euro Pacific, certainly call in to talk to one of the brokers, and they can walk you through the logistics of that. But the situation is, even if you have a little bit of capital, certainly you could use one of the Chinese currency ETFs, and it's better than being in U.S. dollars cash. It's not going to pay you a lot of yield, and you're just going to have to be patient for that eventual revaluation. But believe me, the revaluation will come at some point.
Is there a way to take advantage of that in the short term, or should I look into other currencies as a way to hold on to savings?
I like Norway, Norwegian krone. They have the highest per capita reserves of any country on earth. I mean, Australia, Canada, the Aussies pulled back about 7% recently. So there's a lot of ways to play it. I mean, this dollar rally that you talked about, yeah, we broke above the 50-day. We might rally a little bit more, get a little bit of that bearishness on the dollar out of the way, and then the next leg down resumes. So this is your opportunity. And, well, I've got a special guest on the line as advertised. We have got Peter Schiff, and we have been able to connect to him. Peter, are you there?
I'm here.
All right, how you doing?
How's the show going?
That show's going really well. We've taken some good calls, talking about foreign currencies, foreign stocks, U.S. real estate, the usual. How's the campaign going?
Well, I just spoke in front of a group of people at a town council meeting in Wethersfield, which is just outside of the Hartford area.
Uh-huh.
And I think I was well received there, and now I'm on my way back to my home in Weston. I got about an hour in the car.
Nice.
So I'm not sure how great I'm coming in. How's my voice carrying?
On my end, you're coming in loud and clear, so I'm going to hopefully that the moderator here can connect you to some of the callers. We do have...
Who else is on besides... Is there anyone else other than you on the phone?
No, it's just me and you. So we've got 3 or 4 callers lined up, so if you want to take some calls, we can do that. Otherwise...
Well, I'll talk a little bit. I don't know. Did you hit on anything about GMAC or...
I talked about the $3.8 billion addition on top of the original $12.5 billion. Well, we're 56% ownership now. Basically the government is slowly on the path to fully taking it over. It's the private.
Yeah, the problem with these government bailouts is, the way capitalism works is that when you're generating a profit, that means you're doing something right? You're combining resources in an effective way, and you generate a profit.
Correct.
And the profit is the market's way of rewarding you for doing the right thing. And the companies that are making profits can expand and get bigger because they're doing the right thing. But on the other way, if you do the wrong thing, you lose money. You get a loss. And what happens there is that activity ceases because you can't keep losing money forever. So the fact that you're losing money is a sign that you're doing something wrong. And obviously, General Motors, Acceptance, GMAC, is doing something horribly wrong because now they've had to be bailed out for a third time. But instead of letting the market put that company out of its misery, right, they keep perpetuating it so it can do even more damage to the U.S. economy. They can squander even more resources. And in order to keep GMAC in business, they have to take resources away from other companies that are doing it right, that would otherwise be growing and expanding and benefiting the economy. Instead, they suffer so we can prop up these companies. The same thing is going on with Freddie and Fannie. And every business that the government decides to bail out is a business that the economy would be better off without.
Yeah,
and,
the world.
So it's just enforcing all the wrong things.
Sure.
It's the reverse Darwinism, and we've got to get our leaders to understand the capitalistic system. They're not in the Politburo over there. This is the United States of America, and they need to understand what that means.
Yeah.
And this last thing they did with Fannie and Freddie, you mentioned that when they initially were in trouble and they bailed them out, when they should have let them fail, the government said, we stand behind these entities to the tune of $200 billion each. We will cover the first $200 billion worth of loss of each company, which is a staggering amount of money, right? But now, last week, they said, that ain't even enough. We're going to cover it all. Even if they lose $500 billion, even if they lose $1 trillion, the American taxpayers have got it covered. Unbelievable. And the fact that they would even raise it shows that they know that this is going to happen, because obviously there were some problems in the bond market. There were obviously some problems. People didn't want to buy the Freddie and Fannie debt because they began to realize that the guarantee only covered $200 billion, and they could see the problem was bigger than that. So in order to get people to buy these bonds, they had to guarantee everything. And so despite the fact that the government is trying to tell us that the housing market is improving, the fact that they had to guarantee all their liabilities shows you that it's not improving, it's getting worse.
Absolutely.
But what else was going on this week in the market? The market is really quiet. The dollar is still managing to trend slightly higher. It's still well below the 80 level on the dollar index,
sure.
which I kind of think is more of a key level.
Yeah, I was looking at a chart earlier.
Gold continues to be on the defensive. Gold continues to inch lower. But stocks in general, both in the U.S. and abroad, are moving higher. And I think foreign stocks are still doing better than domestic stocks, even if you take into account the fact that the dollar is gaining a little bit.
Well, yeah, I was just looking at the New York Times study today. I mean, they came out with a statistics of all the Brazil, Russia, India, China markets versus the U.S. market. And our market is down over the last decade. Those markets have gone up anywhere from 150% to 800%. Big, huge moves. I mean, the difference is just astounding. But All right, let's try to do this.
And that difference, I think that's going to continue. I mean, people don't realize how incredible the outperformance was of foreign markets versus U.S. markets in the decade that's coming to an end.
Correct. There was only 1 year, 2008, where the foreign markets were slightly underperforming the U.S. market, even though the U.S. market was down, and that's simply just because we had a little bit of short covering in the currency markets. But that's all been unwound.
Yeah, and I think my best guess is that the next decade, based on the current monetary and fiscal policies that we're pursuing, that the next decade is going to be even a bigger outperformance of international versus U.S.
Yeah. I mean, there's all the different inputs, whether it's the demographics or the failed government policies or the piling on of debt, all of that's pointing to a lower dollar. Jimmy in North Carolina, are you there, Jimmy? Hello, Jimmy.
Hello?
Yeah, hi.
Yeah, how you doing? I got a few questions for you.
Go for it.
And I want to tell you I'm enjoying every bit of this.
Great.
Okay. My few questions I have is, the real estate bubble didn't even really touch too much in North Carolina. The real estate prices, the majority of the areas have stayed stable. All right. What I'm wanting to know is, all right, that's a later question. Right now, you hit on the double dip of deflation and inflation.
Sure.
Well, what I'm wanting to know is what do you think the total outcome of that's going to be? Is it going to stay like that, double dipping the whole time, or is it just going to...
You've got a situation where in North Carolina, at least the real estate prices didn't launch into bubble territory like some of the other states, Florida, California, etc. And that's good. That means you're not going to have as much of a pullback like you've had in other places. And, well, wait a minute. Looks like we got Peter back on the air. Peter, are you there?
Yeah, I just lost the cell phone connection. I started talking about, Japan, because the Japanese market hit its high 20 years ago.
Sure.
When the Nikkei was around 39,000. And here we are, 20 years later, you've had 2 decades of Japanese stocks underperforming, and, they had a bubble, and it burst, and the government did all the wrong things, and look at the mess they made in a situation where the fundamentals of the economy were a lot better than the fundamentals are for the United States.
Correct.
So if the Japanese market fared so poorly over 2 decades, in a post-bubble environment, I mean, I shudder to think how much worse it could be in the United States when, they're at least a nation of savers and producers and exporters, and we're drowning in debt.
Well, yeah, at least you can buy the dip in Japanese stocks. Some of those are selling at single-digit PEs, and they export to all throughout China and Asia. So, I mean, you're getting the Asian growth at a reasonable price.
Yeah, look, I think at some point Japan's going to turn around. I think that Japan offers a lot of value. I do think there's a lot of government debt that the Japanese government has.
Correct.
And that's unfortunate. That's because of all the misguided economic stimulus, Keynesian policies that they've pursued for the last 20 years. But, other than that, I mean, the economy is still basically sound, other than the enormity of the government debt. And if they simply stop buying all these dollars and allow their currency to rise, I think the Japanese government could pay off and, start paying off that debt. And, Japanese citizens can start enjoying a better rate of return on their savings.
Okay, the caller, when you got cut off, I took a caller named Jimmy in North Carolina, and then he got cut off. He's back on the line, and we're going to connect him so he can ask you a question. Jimmy, are you there?
Yeah, I'm here again. All right, the question was the double dip of deflation and inflation. And what I was wanting to know was what y'all see in the outcome between the two, maybe 5, 6 years down the road. And the other question, which this might come out, but this might sound stupid, Peter, if you hear me. But what I was talking about, the real estate, as in it really pretty much stayed, it didn't really bubble out. But I keep on listening to Peter, and Peter keeps on talking about, in the long run, depression and all this other stuff. And I'm thinking that, if my house ain't paid for, and I know it's not going to be paid for, but I have a lot of equity in it, which is not bubble equity, it's just pretty much equity that I've paid down on it. So what I'm wondering is it a good idea to take the equity out, which I know that's the problem with the United States today, get a loan on the equity that's in the house, and take it, invest it in silver, gold, or even take it over foreign. Yeah,
well, on your first question, I mean, yes, it's going to be the double dip, and I would argue that, we're not even out of the recession. Just because from a technical factor, the GDP is now rising, the economy itself is not improving. in most part, the GDP is going up because we're spending more borrowed money, and so we're actually worsening the underlying economic fundamentals in order to generate this phony economic growth. So ultimately, the growth will go away, and we will have the second dip, but I would say is still all part of the same recession because we never really came out of it because the government interfered with it and interrupted its natural course and thereby did not let the market reallocate resources in a proper way that we could have a sound foundation out of which we can have a lasting economic recovery. So I think it's all part of the same recession, but the media will end up calling it a double dip. And, I think the second dip could be bigger than the first dip if we get the currency crisis that I think is coming.
Okay.
As far as your second point, look, I mean, I don't tell people that they should go out and borrow money against their house to buy anything. I mean, that's obviously there's a lot of risk in there. There's an old, Wall Street expression, don't bet the farm, and I guess you don't bet the house on gold. You don't borrow money to buy gold. I'm not going to tell people to do that. If they decide to do it on their own, that's up to them. I think a more realistic approach is to borrow money and buy interest dividend-paying foreign stocks where the dividends exceed the cost of the borrowed money because at least you don't have a carry. If you buy gold and you have a mortgage, every year you're going to have to pay the interest on the mortgage, but you don't get any income out of the gold. Now, obviously, if the gold goes up, you can sell off some of the gold to cover the mortgage, but it's more of a risk. But whenever you borrow money to do something, you're always taking a risk, and you've got to consider, all angles of it, and then you make a decision based on what you want to do and the risk that you want to assume.
Well, see, it's just like when I was listening to you. It's like, am I thinking, am I going to want to go down with the ship empty-handed or come out with something in my hand?
Yeah.
That's pretty much the way I was looking at it.
All right, Jimmy, thanks a lot for your call. We've got the line stacked up. People are chomping at the bit to talk to Peter, so we need to take Alex in Michigan. Alex, are you there for Peter Schiff?
Yeah, I'm here. Thank you very much for taking my call. Two quick questions for you. I know, Peter, you previously had mentioned something different that you've been doing as far as investing directly in buying oil wells in North Dakota. I guess there was a big pocket there. And I wanted to know if that's open to all investors, or is that just something that you decided to do on your own? Because that sounds very interesting.
Well, yeah, I mean, I don't, obviously that particular situation was a private investment. That is nothing that, we can really speak about any details of on a radio program. There are, strict rules and regulations that limit my availability to discuss those types of investments in particular. On a show that just anybody can tune into, and I don't know who's listening, and so we can't really talk about it. But yeah, I mean, we do at Euro Pacific Capital, we do private investments, we do investment banking work, we help companies raise money who need money, and we bring these opportunities to the attention of our clients. And so, if you are a Euro Pacific Capital client and you have a relationship with us, let your broker know that you're interested in hearing about these opportunities when they come up, and then you can discuss, whether they're suitable. You can read our offering memorandums. But I think it's a great time to be doing what we're doing. I mean, most of the private deals that we do, they're in China, some are in Australia, some are in Canada. But it's a great time to be making these type of investments because there really is a lack of credit availability in many cases around the world. The governments are borrowing so much money that a lot of these smaller companies are having a hard time getting bank financing for their deals, so they have to come to the private capital markets, and we can generally negotiate very good terms for our clients. We usually can buy stocks below the market. We get a preferred stock. Remember, when Warren Buffett bought stock in Goldman Sachs, he didn't buy the common stock that everybody else bought. He got a preferred stock with a 10% coupon and warrants. We're doing the same thing. We're buying stocks below the market. We're getting a preferential a position in the equity. We're getting a much higher dividend than the common stock. We're getting warrants. So it's really a great deal. I mean, if you understand the risks involved, and some of the investments are liquid for a time, but it is a great opportunity. And we're trying to ferret out these ideas, and we're trying to only, pick, the best investments that we see. And pretty much every deal that we've done, I've done with my own money. And sometimes I get upset because sometimes they're so popular that, I get forced out because if they're oversubscribed, then I'm not allowed to invest. We have to just so sometimes they get so popular that I'm not even able to put my money in, even though I found the deals. But we can't really discuss any particulars, I said on a radio show. But anybody who's interested can talk to their brokers and make sure that you get the loop. And the next time we do have a private deal that we're working on, we can get you the prospectus and get you the information, and then you can decide if it's something you want to consider.
Okay, thanks. And one more thing, too. As far as owning stock in particular, like common stock, let's say you're going through a brokerage firm, with a lot of problems that's been going on with, firms on the verge of going belly up. When you own stock, is it in the brokerage name or is it in your own name? Like, is there any risk?
Well, if you have an account, with us at Euro Pacific Capital, we don't self-clear, so you actually have an account at Pershing, which is owned by Bank of New York, and so your account is held there. So if Euro Pacific Capital actually went bankrupt, and there's not much of a risk of that because I don't actually have any debts. I don't take any positions. I'm not speculating with the firm capital like a lot of Wall Street firms do. So the chances of me going bankrupt are pretty slim. But even if I did, it doesn't affect the actual position of your account because your account is not at Euro Pacific Capital. It's with Pershing. Now the question is, what happens to your account if Pershing goes bankrupt? I don't think that's going to happen. I think they're probably too big to fail, and I think the government would bail them out. They are the largest clearing firm, and they're owned by Bank of New York, so they're probably not going to fail. But if they did, I don't know. If you have a margin account, you're clearly at risk because you've hypothecated your securities to the clearing firm, and it's now part of their assets, and so you're a creditor. If you have a cash account, you don't have anything on margin, my feeling is that your assets are probably safe. Certainly there is some insurance on your account. You get SIPC insurance up to $500,000. Obviously if you have more than that, then I think there's some private insurance there. But then, of course, you have to get into what about the insurance? What about the counterparty risk? So, I can't answer that question 100%. But my money is there. I have all my money at Pershing pretty much. So, I'm taking the same risk as you guys.
Okay. All right. Thank you very much for your time. I appreciate it.
Thanks a lot for your call, Alex. We have Robert in California. Robert, are you there?
I'm here. Can you hear me?
Yes.
Great. Thanks for taking my call this evening. I had a quick question regarding variable universal life accounts. My wife and I signed up for one a few years ago, and we've been putting money in there ever since. And I'm just curious what Peter's thoughts are regarding these investment vehicles. And,
I know, without just condemning the whole industry, I do know that there tends to be a lot of, misrepresentations in the realm of insurance as an investment. I know that these products are generally pushed by a lot of people in the financial industry because they are the highest commissioned products out there. I mean, if you put somebody into one of these life insurance policies, the commission that you might make could be 3 or 4 times or 5 times what you might earn if you just bought them, stocks or a mutual fund or something. So I know that brokers have a vested interest at many firms to steer their clients into these types of investments. My biggest problem with them, other than the fact that they're usually very heavily laden with fees, is that, you're talking about U.S. dollar investments with American counterparties. I think there's credit risk there, and I think there's inflation risk and, purchasing power risk. So I don't think that it's where you want to be. You don't want to create, annuitized streams of dollar income. You don't want to have, you don't want to be collecting some sum of dollars at some distant point in the future when you have no idea what, if anything, those dollars are going to buy.
Okay. Well, I guess my thoughts were, in the future, imagine being here in America, we're going to have to pay our bills in dollars. So to be vested... Well,
that's right, but that doesn't mean you have to keep your savings in dollars. You can convert your euros or your Australian dollars or your gold bullion into U.S. dollars when it comes time to pay your bills. And if I'm right, it'll be a lot easier to pay those bills if you've got your money in gold or foreign currencies when those bills come in, because those bills will keep getting smaller and smaller and smaller relative to your foreign assets. That's the whole idea.
Okay. Yeah.
Now you want to keep some of your money in dollars to pay the bills that you're going to get next month, next week, maybe in 6 months. But bills that you might incur in 2 years or 5 years, why would you want to hold that money in dollars?
Mm-hmm. Okay. I know. Well, for this one in particular, there are penalties if we withdraw any funds too soon, and basically we would lose almost everything. And so rather than doing that, I thought, well, if we could fund this, continue to fund it minimally while placing other funds, in gold or in silver or in, overseas markets, then, would it be okay to hold on to this thing until there are no more fees for withdrawal?
I'd have to actually look at it. I mean, I don't know. Why don't you contact Europe Pacific, talk to a broker, maybe give Heyman's office a call. Let Heyman, take a look at what you have and evaluate, what the options are, and if there's something better to do. If maybe cashing that policy in and making more prudent investments would make sense, or maybe you should keep it. But it's hard to comment without actually, taking a look at it. So I said, why don't you? I'm sure Heyman is got some time and can take a look at it.
Okay. Well, I've contacted a broker in your Newport office before, so maybe I'll give him a call.
Okay.
Okay. Thank you very much.
All right. Thanks a lot. We've got wide open phone lines, 888-678-9597. I think I just lost Peter at the same time. So not only have I lost Peter, but we've got open phone lines. So if you have a question, there is some time left in the show. I did want to touch upon what that last caller was talking about. He's saying there's little value, and so should he keep funding it? Now think about that statement. The way that these brokers in these type of other products get that high commission, sometimes as much as 90% of the money you put in the first year goes to the broker's commission. The way that happens is what the insurance company does is they load up these back-end fees that they have to pay the commission to their broker right away. So how do they guarantee that they earn a return on that? Well, they make the client who's buying the investment product suffer. You cannot get out. You're stuck once you do that, and so that's the whole issue. 888-678-9597. I do have Brad on the line, and I believe you're in, what is that, Washington? Brad?
Yeah, this is Brad.
Hi, what state are you calling from?
I'm calling from New York.
Oh, okay. How you doing today?
Hey, pretty good.
We had Peter on for a while, but we just lost him. He's in his car, so sometimes that happens.
No, that's all right. That's all right. I listen to you guys every week. So,
what can I do for you?
Well, I'm wondering what's going to happen if there's a dollar devaluation.
Sure.
What's going to happen to your personal debt?
Well, your debt will be devalued, with everything else. So, this is the crux of the situation. How does the U.S. government address the fact that we have $80 trillion of unfunded liabilities between Social Security and Medicare? How do they address the fact that they are pouring a mountain of new debt into the system? Well, they're not really worried about it because they can devalue that debt. They can keep inflating the currency, and the present value of that debt will continue to be devalued. It's the very easiest thing for them to do. That's why they call the inflation tax an insidious tax. It is the tax that the average man on the street might not understand, and at the same time, they tell you that there is no inflation. They'll tell you that the CPI is at 0%, and therefore they don't have to give any cost of living increases to Social Security recipients. And it's the people who need it the most, the people who are seeing their health care costs go up by 10, 12, 15%, and that's now before this ill-thought-out Obamacare that's coming in. They are going to get hurt the worst because they don't have the cost of living increases. And so if you have some debt and it's fixed interest rates, and you have extra cash flow, it might make sense if you have very good terms to hold on to that debt and take the excess cash flow and invest it in some foreign bonds, some foreign utilities. Certainly I'd reach out to one of the brokers in the West Coast offices. There's probably people there, and talk about the different alternatives that you have. And, well, guess what? We got Peter back on the air. Peter, are you there?
Yeah, I had a second cell phone. My battery died. I should have been using this one the whole time. It's a much better reception on this phone, that's for sure.
Yeah, actually, I got you loud and clear, and we got a good 5 minutes left in the show, so I'm glad you called back.
Anyway, we only have about 5 minutes. Are there any callers left on the line?
Well, I'm speaking to Brad, and he had a question about the interest rate he has on his. He's got some debt, and he was talking about a dollar devaluation and the fact that would probably devalue his existing debt. And so we're just talking about that. And what are your thoughts on that?
interest rates have been backing up. I mean, the yields on the 10-year and the 30-year U.S. Treasury bonds have been inching higher almost every day for the past month or so. And the Fed is also trying to talk about a way to withdraw the liquidity, but they don't really want to withdraw it. Right? They're afraid to really raise rates, so they're talking about these term deposits, which are kind of like offering CDs to banks where they can borrow money cheap from the Fed and then loan it right back to them at a higher rate of interest, which makes no sense at all. I mean, why give them the money if you're just going to let them, let them give it back to you and pay them a risk-free rate of return? It makes no sense. They're grasping for straws because they know that they can't really remove the liquidity. They can't raise interest rates because it'll topple the whole phony economy that they're trying to perpetuate.
Yeah, you know what? We got Brad. Brad, are you still there? Are you listening in to what Peter's been saying? Did you have a chance to listen to what Peter just said, Brad? Hello, Brad, are you there? Oh, maybe we lost Brad. Anyway, yeah, basically, I think it's just ludicrous what the Federal Reserve is talking about. They're just moving money from one side of the balance sheet to the other. The systemic issues that we have are only getting worse, and so the fact that they're saying, "Oh, we're going to offer these different kind of products," it's completely useless. So, I mean,
meanwhile, they've got to shrink their balance sheet, but the only way to do that is to sell off these toxic assets that they own. But sell them to who buy them, and at what price? And the minute the Fed tries to get rid of these assets, they're going to implode the entire housing market and the market for student loans and for automobiles and credit cards. The whole thing's going to come to an end the minute the Fed tries to sell these assets, because right now they're buying the assets, and they're the only buyer. I mean, that's why the mortgage market, 96% of the mortgages are from the government now. Why is that? Because the private sector won't touch them. The private sector won't lend because they know that they're going to lose money. They know that collateral is bogus. Housing prices are too high. People are spending too much money. They're overpaying. They don't have enough equity. They don't put enough skin in the game. Nobody would finance these transactions without the government backstopping them, which means they shouldn't be taking place. All these mortgages, all these homes that are being bought with government-guaranteed mortgages, these transactions should not be taking place, and they would not be taking place in a free market, and that's the problem.
Now, I think we've got a couple minutes left. Brad, are you still there? Because I'm getting a note here that you've called in again. I'm going to give you one last chance to announce yourself. Brad in California, are you there? Okay, so it looks like
I guess that's it for the calls. Do you have any last words you want to say? We're only got a couple minutes left.
I want to touch upon the vast, the way you need to look at these markets. Now, we just finished a decade where the U.S. did nothing. In that whole decade, we have 10 individual years, and in 1 year, the U.S. market was slightly outperforming. But in that year, people got afraid, and that memory is what they are looking and holding on to right now, and they just don't know what to do. I'm asking people, listeners today, clients of Euro Pacific, clients people are thinking about opening accounts, to look at the grand scheme of things. Look at what has happened. The U.S. GDP continues to contract as a percentage of global GDP. The inflation that's being created by the Fed continues to filter into hard asset prices. The things that Peter wrote about in Crash Proof way back in 2006 have all come to pass. So when you're talking to your supposed advisors from the Wall Street media or from Wall Street banks, to keep that all into context.
They're playing the music, so I guess that's it for this week, everybody.
Thanks, guys.
Thanks for helping out, Heyman. I really appreciate it. Thanks for listening, everybody. Tune in again next week for another episode of Wall Street Unspun. Don't forget to call 800-727-7922 to talk to a broker. And if you haven't read Crash Proof yet, pick up a copy of Crash Proof 2.0.
All right. Thanks again. Signing off.
Happy New Year, everybody.
Happy New Year.
This is the last show. It's nights of 2009.
Right.
Last show of the decade.